Welcome everyone. Today we have once again for the third time Likerty, and today he is presenting one of his winning articles, actually second place winning articles for in the Dukascopy October Article Contest. So congratulations, Likerty. Seems that your article was favored by numerous community members that has received recognition and allowed you to obtain second place in the contest. So congratulations, like I said, and feel free to launch with the webinar. And all the guests and viewers, feel free to type your questions in case you have them.
Well, the topic, of course, is controversial a bit. You can see trend lines used by almost any analysts in almost any publicized analysis, and you gotta believe in trend lines and moving averages if industry professionals use that. But thing is that when it comes to the industry professionals and publicized our shared views, those often have to be viewed in the context of PR campaigns and market movers. Not only that they try to lure in smaller participants when playing with technical sentiment in the charts, they also play with the fundamental sentiment, and those bank recommendations around, you can always count how many of them failed, and moving average and trend lines are kind of largely accepted and very popular technical tools, but everyone who tries to trade on them, use an analysis on them, definitely encounters the dark side of this method, and well, you just simply getting stopped out just too often. If you trade long enough only on trend lines or moving average or any of the most common indicators, you're suddenly starting to realize that something is not with that tool. Just too many times you get stopped out, and then you're trying to think that maybe something is wrong with this approach. And well, I find out my own methods how to pre-calculate future ranges, turning points. Essentially, I'm trying to follow the story of a market mover. I'm trying to identify where they enter, what are their targets, and where they exit. And I will start an art series. I will try to explain how I do that. But for now, I'm just criticizing a bit and arguing. I'm trying to, arguably state some facts which must be known for, especially for all the newcomers who usually blindly believe in those things. Well, right here I'm showing, this is a slide from the article, and one of the examples, actually, how sometimes you can see some coinciding points and think that, well, price reacts to the one moving average or another trend line or whatever. But there always are other levels. All the ranges are usually tagged with various levels, various deviation points of the current and future ranges, and they interact with each other. There is always a risk to reward game against the highs and lows of the range. And as here, for example, this is, well, as article was written in September. This example is from September when euro dollar surged from no taper decision from FOMC, and then it started to slide back. And this part of the range was most crucial. Myself, I took quite a few stop losses. I constantly tried to long in various places, and and finally I got some of the trades in green, but essentially I didn't make much in this situation. And my problem was that maybe I was a bit too eager. I had too many maybe different scenarios. You can always suspect a possible retracement when such gaps in price action are created. But when you analyze more closely to what really happened, after some time passed, it's a bit easier to analyze those things, of course. But essentially, on intraday basis, price action was terribly short. And those types of sliding consolidation, not really a proper swing, there was, you could say that there was a battle between bulls and bears, but I would say that there was some aggressive long position covering and re-entering again, covering and re-entering again, basically from one hand to another. One market mover could do that with giant positions, just playing with its own exposure. Anyway, there were some technicalities. I talked in my webinars and posted on Twitter. And all those levels, all they played quite nicely. And when it started to move outside of this consolidation, well, it created a bull impulse point. For example, you can see that something started, and that right here you can slice this whole range into two parts in the context of timing, and you can see that something started right here, and later on it moved higher and higher and created those higher highs and higher low sequence. And this impulse point, it played all over again and again, and not only when price approached this previous, well, second day it was a New York session lows that it didn't broke and retested and so on, but there were other deviation points which got respected on the way up. But here it comes 100 simple moving average. And as I always said, one of the most ridiculous things is that even if price action essentially doesn't move, it consolidates. And if it consolidates long enough, then some moving average or some trend line will approach it sooner or later. This is exactly the case. The actual trend line, moving average wasn't even touched exactly. And smaller time frames, so you can barely find few coinciding points, and then all the logic is actually, in between the lines. I also mentioned on the article that if you are so eager to find and trade trend lines, there is a bit sort of exception to the rule of sorts, which is first test of a trend line, of a newly formed trend line. Of course, if you have only one spot, it's very difficult to determine where the next trend line could be. And if you didn't catch the second, third approach, usually ends up with breakout, or if not, then fourth one, or every second approach is just weaker and weaker. Well, anyway, I have a separate article on how one could find future trend lines. But when you focus on horizontal levels, it's much easier actually, and those methods are more precise when you look for horizontal levels, and generally try to follow this. So where are the entry points which could be defended? Where are the profit taking points? And so on. And also, if you're talking about euro drop, current intraday euro drop, then not I didn't solve I expect another comeback to the highs and break higher. Actually, just it's not clear yet. I mean, it will show for a moment. Well, as it might look like respecting these highs, it could be the case, but it has plenty of rooms to continue from, and it has some nice levels to react later. But webinar is not about current euro-dollar situation. Well, what can I say more? Another problem with technical analysis in principle is that, well, price moves in segments. It likes to respect its own middles, quarters, and so on, and you can always slice price action in some, almost in whatever you like. You can blindly just put 25% or 12.5% deviation sequence, and you will see some movements from one segment to another, and you can scout those movements, and all those other technical tools, they sometimes work because, well, markets just doesn't move randomly. They move into segments. Usually you can find that there is consolidation, then it breaks, makes another consolidation break, and makes another consolidation back, moves again into the previous segment, consolidates again, then breaks back and moves. Problem is that almost all of these popular used tools, they seem nice on historic price action, but when it comes to real-time decision making, real-time trading, well, it is really difficult, especially when you see price piercing, let's say, line which you want to trade, and pierces back and forth, and you're never sure will it broke the line or not. 1 hour closed below, another hour closed above, then came back below. Well, it's very individualistic. How do you prepare your risk limits, or where you project your targets? And when you use trend lines or moving averages, you gotta take price action, recent price action levels into consideration. Let's say I'm longing right here, my stops are below lows of the range, but you can trade on the same principle without moving average or trend line. You just can buy at the lows, sell at the highs, or whatever. Just look for proper attractive risk reward situations. Try to identify K highs or lows against which you're playing, and it's in one hand it's real simple, another of course is difficult when it comes to psychology and so on. But my view is that trend lines and moving averages are better to be ignored at all. You can play some major ones, daily, weekly, monthly charts, just to have what others have, to see some possible hesitation areas, but not for trading decisions. And I could give you one straightforward, rock solid fact. When price approaches some major trend line and it breaks the trend line, who are the buyers? Definitely not those retailers, some deep pocketed retailers who trade trend lines. Those are the market movers who bet into that liquidity around the trend line or moving average and make that breakout and cover that position on the next cluster of liquidity usually in form of stop losses and so on. They ride back and forth those levels, and it's just, I don't think that it's educated enough approach actually to trade those visual aids on the chart. You gotta use your head if you want to trade. That's my view. Well, that's about it, I guess. Everything what I didn't mention is still on the article. You can find it. Main points are that you gotta be critical and don't trust what Bloomberg or other financial media is telling you. Everybody has its own agenda. Everybody promoting their own positions when disclosing their views. Did you ever notice that bank recommendations are never against the sentiment? They always kind of try to strengthen. You know, you see some drop in the charts, and they say, "Oh, it's bearish, yes, blah blah blah." But and you see some breakout on after a few days or weeks, significant breakout. All those movements which contradicts fundamental and technical sentiment are always volatile. Hey guys, do you have any particular questions regarding my article? For those who didn't read my new one yet, please go read Mike if you like it. I'm hungry for likes. Oh, well, okay. I don't know if there aren't any suggestions what to talk about. I guess I will end. It was a long day today. Mondays are very busy always. Usually, it takes the whole Monday to figure out what they wanted to do on Friday. As for example, I'm looking to euro-dollar price action now, and I see that on Friday they prepare to attack the highs, and it will break the highs. It's only a question of time. And I'm waiting at 630s to short the crap out of it. Usually webinars get funny either late in the day or when you have a profitable day. Okay, bye bye now. See you tomorrow. Good luck in your trading. Bye bye.